Hi everyone, welcome back to our channel. We have already studied in our last videos how quantitative tools like CRR, SLR and Repo Rate control the total money supply in the economy. But sometimes the central bank doesn't want to affect the entire economy. It only wants to guide credit in specific directions. That's where the qualitative approach comes in. These tools basically focus on the purpose of the loan, the sector where the loan is going, and the direction of credit flow. So instead of controlling how much money is available in total, qualitative controls decide where and for what purpose the money should be used. Think about it. Should the same rules apply to a farmer taking a loan for seeds and to a businessman borrowing for luxury imports? Obviously not, right? That's exactly why RBI uses qualitative tools. Now let's move to the first tool, margin requirement. Margin requirement is a difference between the value of collateral and the loan amount granted. Example, if you mortgage a house worth 1 crore and the bank gives you a loan say 80 lakhs, then the margin is 20 lakhs. That's a simple maths, right? But how does RBI use this? So during inflation, RBI increases margin requirement. Bank will then give you smaller loans against the same collateral. So less credit equal to less money supply. During deflation, RBI decreases the margin. Bank can now lend more against the same collateral. So more credit enters the economy. After the 2008 global financial crisis, RBI reduced margins on certain loans to allow more borrowings and push growth. Similarly, in 2020, during COVID 19, margins were relaxed for some businesses to encourage borrowings and keep the economy moving. Margins are also adjusted depending on the sector. For, for speculative sectors like real estate or stock trading, RBI keeps the margin high to discourage the risky borrowings. So the flow goes like this. Rise in the margin requirement will lead to fall in credit demand, which will lead to fall in money supply and inflation would be controlled. On contrary, fall in margin requirement will there will be rise in the credit demand, there will be rise in money supply and deflation will be controlled. Now next tool is rationalization of the credit. This means that the RBI fixes a limit or quota on how much credit banks can give to certain sectors. But why the RBI does that? Because it will help to prevent overlending in risky or speculative activities. So during inflation, RBI might say banks don't lend more than a fixed quota to some sectors. This will ensure money does not go into that specific sector, helping control inflation. Similarly, during deflation or slowdown, RBI may relax these quotas so more money flows into businesses and economic activities pick up. So the flow goes like this. When we introduce the credit rationalization, the supply of credit decreases, money supply will fall, and inflation would be controlled. While on the contrary, when we are withdrawing the rationalization, more credit supply goes in, there will be money supply will increase and economy boosts during deflation. So rationalization helps the RBI direct credit to the right sector at the right time. Think about it. If every bank keep giving unlimited loan to builders during inflation period, what will happen? Obviously, the property prices will shoot up. That's exactly what RBI wants to prevent. Let's move to the next one, which is moral suasion. This tool is little different because here the RBI does not use forced or legal orders. Instead, it uses advices, requests, and persuasion to guide banks. During inflation, RBI may request bank, please restrict lending to say luxury imports and speculative activities. And during deflation, RBI may guide bank to be more liberal in lending to agriculture and manufacturing sector. So it's more about influencing bank through guidance and pressure rather than strict rules. During the 2016 demonetization, RBI used moral suasions to advise banks to lend more to priority sector like agriculture, small businesses and rural development so that people have the access to credit when the cash was short. So here it works. If banks listen during inflation and restrict loans, the lending will drop and the money supply will fall down. Similarly, if banks listen during deflation and lend more, lending will rise and the money supply will rise. It depends a lot on the cooperation of the banks. Model Suasion has been useful and a flexible tool for the RBI, especially in India. So let's summarize. So margin requirement basically control how much loan can be given against a collateral, while credit suasion basically put limits on the lending to a specific sector. Model suasions basically RBI persuade banks to align with monetary policy. Together these tools help RBI control inflation, fight deflation and direct credit to the most productive areas of the economy. And that brings us to the end of this video on the qualitative approach of credit controls. Don't forget to like, share and subscribe if you found this video useful. In the next video, we will continue with more interesting concepts from the money and banking unit. Thanks for watching and see you next time.